If we indeed enter a liquidity crisis, which is a very high likelihood in the future, everything gets sold. Everything but dollars and short-term bonds and shorts those are the only things that are really going to work. That happened in 08 where you had that, gold ran up and then the global financial crisis hit, and banks sell what they can. And one of the things they can sell is physical gold. So gold got hurt for a while. It was on the other end of that. So early 09, when all the way to 2012, or I think it was 11 or 12. Where gold just skyrocketed in value. I anticipate another such function to occur. Do I have a price target on silver? I think it is going higher because in stagflation, hard assets are going to soar. So I think it goes much higher. It wouldn't surprise me for it to double in price in the next few years.
The Federal Reserve has been called many things over the past century, but Michael Pento doesn't hold back. He sees it as a disaster that's hollowed out living standards and distorted markets beyond recognition. And while Donald Trump has floated the idea of scrapping the Fed, Pento argues the reasoning is off. The problem isn't that the Fed isn't cutting rates fast enough. It's that the institution exists at all. Pento's case is straightforward. Money supply shouldn't be manipulated by a small group of policymakers who chase short-term political goals. Instead, it should be tied to something real, something that grows predictably over time. Gold, with its annual supply increase of about 2%, fits the bill. That pace aligns with population and productivity growth, making it a natural stabilizer. With such a system, bubbles are harder to inflate, debt is harder to abuse, and when banks take on reckless leverage, they fail, exactly as they should in a functioning market. As for gold's future, Pento sketches out two phases. First comes the potential liquidity crunch. In a panic, investors sell what they can, and gold isn't immune. Just as in 2008, it could take a temporary hit. But history shows what follows. Between 2009 and 2012, after the sell-off, gold ripped higher. That's the second phase, the real move. And layered on top of this is the broader backdrop of stagflation, where growth stagnates but inflation persists. In that kind of environment, Pento says gold shines brightest, warranting as much as 20 to 25% of a portfolio. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
So Trump is 100% correct that we have to fire most of the FOMC, if not abolish the Fed. I mean, there's just a horrible institution. But he's 100% wrong as to why he wants to fire the Federal Reserve. The Federal Reserve is perpetually, ever since 1987, really, starting with Greenspan all the way through to Powell, perpetually edged on the side of destroying the purchasing power of Americans. So, for example, if I just told you that inflation is now running around 3% and the Fed's target is 2%, that means inflation is running 50% above the Fed's target, and it's been above the Fed's target for 52 months in a row. Would you tell me that you'd be more inclined to hike interest rates or start an aggressive rate cutting cycle? I mean, it's just mind-boggling to me that they're actually going to do this. So, listen, we need to end the Federal Reserve. We need to end that institution, close the Eccles building. And not because they don't cut rates fast enough, it's because they've destroyed the living standards of the average American. We can do without a Federal Reserve by just what we used to do is we fettered money supply. Look at the base money supply, which is what the Fed controls. If you fetter that base money supply to about what the increase in the mine supply of gold is, that's why we tied money to gold in the first place. It's about 2% per annum. And that's commensurate with population growth plus productivity growth, which is equal to GDP. So you never have an asset bubble anymore because you fettered the money supply growth to the increase in the labor force growth and to the increase in GDP and to the increase in productivity. And then if you really bind the hands of the fractional reserve system and the banking system by saying, listen, we're looking at your assets, your loans, as compared to the base money supply, and that ratio can never get above a certain level. And if you go out above your skis and you go out of business, you are going to fail. We'll allow you to fail, bank. Then you're not going to have these asset bubbles any longer. Get rid of the Federal Reserve and let the cost of money, interest rates, be a function of the supply of savings versus the demand for money. Yay. That's all you need, Jesse. And we've solved so many problems in this country just by doing that. Well, I've always espoused owning 5% of your net worth in gold, in physical gold. So let's start there. That hasn't changed. My portfolio, which invests in liquid paper gold, and by that I mean GLD, IAU, AAU, the gold, the physical gold mining ETF, where they say that they have the gold backing those holdings. I don't know for sure, but I know that the holdings are liquid and the price goes up when the metal goes up. I know that for sure. And there's also mining shares, which have vastly underperformed the metal. And I don't see any reason why that would change, because one of the things that makes gold so valuable is it's so hard to get out of the ground. You have to, spend a lot more money getting an ounce of gold out of the ground. So that's one of the reasons why I love the physical. Not to say you can't make money at times. I have some royalty stocks in the portfolio now too, but I also own platinum and energy as well. So gold is essential to have right now. It's about 10-15% of the portfolio right now. That's in addition to the physical that I espouse you hold yourself. So you asked me what's next for gold. I see two things that you should be aware of. Number one, if we indeed enter a liquidity crisis, which is a very high likelihood in the future, everything gets sold. So everything but dollars and short-term bonds and shorts those are the only things that are really going to work. That happened in 2008, where you had that, gold ran up and then the global financial crisis hit, and banks sell what they can. And one of the things they can sell is physical gold. So gold got hurt for a while. It was on the other end of that. So early 2009, when all the way to 2012, or I think it was 11 or 12, where gold just skyrocketed in value. I anticipate another such function to occur. I can't give you a timeline. I'm monitoring it every day, but I would be, I own gold. I continue to hold gold. I'm leery of that juncture in time where I see a financial, a liquidity event. I'd probably lighten up, and then I would go. I mean, if you're not a trader, then I would just hold your gold. But on the other end of that, would I see a protracted, intense period of stagflation, I would be a very big buyer of gold, even increasing it to 20-25% of the portfolio. So the only caveat I have about buying silver, and to some degree platinum, is that they are also used in industrial purposes. So any kind of weakness in the global economy, which I think is a very real possibility globally, it's evident here already, but it could even be globally, would depress the prices of those two metals more than gold, more than it would gold. Do I have a price target on silver? I think it is going higher because in stagflation, hard assets are going to soar. So I think it goes much higher. It wouldn't surprise me for it to double in price in the next few years. If Trump is correct, again, I voted for him twice, so I like most of the things he does. So let's just not excoriate me on the comment section about how much I'm a liberal, because I'm a libertarian, which I'm for the people to have the power and the government to be, a system of redress and military, but not much else. So I'm definitely for freedom. But if the economy is so great, Mr. Trump, why do we need aggressive rate cuts? He's advocating for a 50 basis point rate cut on September 17th, next week. Why would we?
This week, in 2 days. Yeah.
I'm sorry, 2 days. Wow. How time flies when you're having fun. So, why would we do that? I mean, let's look at so we have record stock prices, home ownership that's unaffordable to most Americans that can't afford a first-time house. Credit spreads are very tight. Financial conditions are as easy as they can possibly be. The total market cap of equities as a percentage of GDP is at 218%, which is unheard of in history. The average of the market cap of equities to the underlying economy, which is usually about 90%, that's fully valued equities. Now it's 218%. And the middle class has been eviscerated, yet somehow we need to embark on a massive rate cutting cycle that starts with 50 basis points. It's insanity. And you wonder why gold is doing so well, and you wonder why platinum is doing so well, and you wonder why silver is doing so well. It's obvious to me for those reasons. Is that not only are you shown, the government has shown they have no interest in living in reality, and I guess the biggest reason, if you want to be honest, is because when T-bills, which is where the Fed is now, where the Treasury is financing all of his debt. If the T-bill rate is 4.5%, the interest on the debt is much higher than if the T-bill rate was like 2 or 3%, which is where they want to take the overnight interbank lending rate. That's the reason they're trying to bring down interest payments on the debt.
Michael Pento points out a critical detail that most people miss when talking about Federal Reserve policy. The last time Jerome Powell cut rates by a full percentage point, in late 2024, the long end of the yield curve didn't follow lower. It jumped by the same amount. That's important because it's long-term rates that determine the cost of mortgages, auto loans, and corporate borrowing. In other words, the Fed can slash short-term money market rates all it wants. But if capital market rates rise in response, households and businesses don't get relief. They get squeezed harder. That dynamic underscores Pento's broader critique. The U.S. economy has been hollowed out by decades of financialization. Easy money policies created repeated asset bubbles while gutting the middle class, leaving wealth concentrated in fewer hands. The result is a structure that looks less like a productive economy and more like a system propped up by debt and speculation. Still, Pento isn't a permanent bear. He's long equities at the moment, guided by an algorithm that tells him when to step aside. The key, he says, is discipline, because eventually the reckoning comes, and when it does, the same leverage that inflates bubbles will magnify the collapse. Let's get back to the interview.
Last time the Powell cut interest rates by 100 basis points was in late 2024, and the long end of the yield curve rose by 100 basis points, which, by the way, is where mortgage prices are geared towards, where corporate borrowing was done. So go and try to lower interest rates on the short end on the money market and watch what the capital market rate is, and then tell me how happy you are and how great the economy is doing when mortgage rates and corporate borrowing costs soar. Auto loan rates too are also a function of that longer end of the Treasury curve. So that's, by the way, that's what I'm looking at. That's what my model is myopically focused upon, is credit conditions and financial conditions for when I need to get out of the market. See, I want to preempt anybody saying, well, sometimes I'm interviewed almost every week, and some body will say, well, you've been negative for so many years. Well, okay, I manage money for a living, so my returns are available for anybody to see. And we're making money this year. And we're making money. I made money almost every year I've managed money, except for I had a small loss in 22 because the bond market completely blew up, and I had a small allocation there. But if I was perpetually negative and perpetually short, then I would be out of business. I wouldn't have a business. I'm perpetually negative on the construct of the economy and the way the financialization of the American economy and the asset bubble driven nature of it. Negative real interest rates, nominal rates that were mostly nominal rates below 1% for most of the time between 2008 to 2022. Okay? That's what I'm negative on. I'm negative on the fact that the middle class has been wiped out. I'm not happy about that. Now, does that mean I'm negative on the stock market? No, I'm long the stock market right now. But I have an algorithm, a robust algorithm to let me know when I need to get out. Because the great reconciliation of asset prices is going to occur. And, when you have a total market cap of equities that's 218% and it should be 90%, there's only two things that can happen. Equities could stay here and then GDP could slowly catch up. But it's more likely going to be like this. They're both going to go down. GDP is going to go down, but asset prices are going to crash. That's what's happened every time in the past. The catalyst will be the fracturing of the credit markets. And if you don't have a plan, if you're going to sit there and say, oh, I own NVIDIA, and people are going to invest in AI. Well, the customers of Google and Amazon and NVIDIA and any AI purveyor, those customers run out of money in a recession. They don't have the capital to throw at NVIDIA. So their business is going to dry up and it's going to crash like Cisco did in 2002. And it doesn't mean that the internet is bogus or we don't need fiber optic cable and switches and routers. It just means that a recession shuts off the capital investment and these companies will crash. And you want to avoid that in your buy and hold target date fund. You need to avoid that. If I'm correct, the way you're going to survive and thrive in that environment is owning short-term treasuries. You might be able to own the US dollar, but I'm not quite sure about that. I have to, model that more carefully because normally the dollar surges in that kind of environment. It's just a repatriation of the dollar from the carry trade. I don't know how big the carry trade is, but when you short dollars and buy other stuff, I'm not sure it's as big as it used to. I don't think it's as big as it used to be. So the dollar's probably not going to save you this time. So short-term treasuries would be wonderful. Cash, yes, but you have to be able to short the stock market adroitly. If you can short the stock market and it goes down, I think it go down anywhere between 35 to 50%. That's about where I see it happening in nominal terms. In real terms, a lot lower. You could really then you have, not only have you saved yourself all that capital, but you have even more to reinvest when they start this massive stagflationary process. Jesse, we have a $2 trillion. We already have a $2 trillion budget deficit for fiscal 2025 with 1 month left in the year. So you have $2 trillion deficits when things are great. Supposedly, Trump says it's the best economy we've ever seen in the world, but we have $2 trillion deficits. And that includes all the revenue from tariffs. We still have over a $2 trillion deficit. In the next recession, deficits are going to go automatically because of the stabilizers that kick in, between $4 and $6 trillion. That's the annual deficit. And that's going to have to be bought by the Federal Reserve. We don't have the savings for that. So you're talking about helicopter money, a form of helicopter money, a de facto and maybe even a de jure helicopter money regime where the Treasury's piling into even more debt to be, stimmy checks will be going out to people again. And inflation's not going to stop the way they counted at 9%. It was actually closer to 17 to 20%. That's how high inflation was, and that's why the middle class is hurting right now. I mean, incomes. You say, well, income. Some people actually say, well, the income has kept up with inflation. No, it hasn't. Maybe the phony inflation figures, but if you're on Social Security, tell me how your income has kept up with inflation. I mean, you're getting the average Social Security recipient receives less than $2,000 a month. A month. So $24,000 a year. And you get an increase of a couple of percent. How does that offset the cost of owning a home or insuring it, or electricity bills that have soared, or the price of food? So it doesn't make sense to undergo another round of massive monetary easing. But I sadly have no faith that we have learned anything from anything we've ever done wrong. I mean, the Pavlovian response to a recession or a downtick in the stock market since 1987 is to print money, borrow money, and print money. That's what they do. And from what I see now, we're doing it. We don't even have a crisis yet. What is the crisis? The crisis is what? That the unemployment rate is at 4.3%? That's not a crisis. That's very low, historically speaking. What is the crisis? Tell me where the crisis is. There's a crisis in the middle class of this country because they've been destroyed by inflation. But nobody's talking about that. They're talking about the need to cut interest rates to boost asset prices higher. Is that what we're doing here? I don't get it, Jesse. No one has told me yet the reason why. Oh, the labor market is going down. No, the supply of labor is down. That is the problem. And that the supply of labor isn't going to increase unless you have a lot of kids being born that have just graduated college. That doesn't work. Gestation doesn't work that way. Or if you open up the borders, that's not going to work. So cutting interest rates is not going to increase the supply of labor. So I think we may have to realize we're going to suffer through, especially when Powell is replaced by some sycophant puppet of the president. We might have interest rates being slashed, a series of cuts, maybe 150 basis points or more. Who knows? Outside of a recession, which I think is very, very inflationary. I think the stock market's sniffing that out too. That's the problem. Leave the money market, go buy some more NVIDIA, because you're not going to make as much holding money in your money market.
Stripped of political spin and academic theory, the core issue is that money management has become detached from real-world limits. When credit can be expanded at will and interest rates are dictated by committee, distortions pile up until the system breaks under its own weight. A structure built this way inevitably tilts toward debt dependence, widening inequality, and fragile markets that can't stand without constant support. Against that backdrop, tying currency to a resource that expands slowly and predictably offers not just stability but accountability. The real uncertainty now is whether change will come from deliberate reform or from the pressure of a market that no longer trusts paper promises. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.